From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Welcome back. I'm Paul Gigot with Kim Strassel and Joe Sternberg. Federal Reserve moving on Wednesday with another 75 basis point increase in its target interest rate. Now the third 75 basis point increase in a row, and signaling that it is going to do another 125 basis points or so before the end of the year. That means just in the last two meetings it has in the year in November and December. And that would take its top rate to about 4.5% on its target rate. Meanwhile, Bank of England raising 50 basis points, Bank of Japan having to intervene in the currency markets to stop the free fall of the yen. Global equity markets very unnerved, keep falling. Bond markets are gyrating. We haven't seen this much financial turmoil in some time, Joe. What are the markets telling us?
Again, I kind of detect two messages here. First, I get the impression that markets have finally really internalized the message that Jay Powell is serious about fighting inflation. I mean, I think partly because the Fed was so slow off the starting blocks when it came to beginning the cycle of rate increases earlier this year, it has taken them a while to persuade markets that they really are serious and that there's going to be a do whatever it takes mentality about getting to the point where they have put the brakes on inflation. And so I think that what you're starting to see after this meeting and, the market reaction to other recent statements that we've had from Chairman Powell and other Federal Reserve board members, you're getting the impression that investors understand that they're serious now. And while that is happening in the U.S., it is accentuating some of the diversion with other central banks. So, you mentioned the Bank of England, which today, Thursday, has increased its policy rate by another 0.5 percentage point, 50 basis points. But here there was an argument about whether they should follow the Fed's lead with a 75 basis point increase. And so there's this difficulty of interpreting the signal that they're sending by having held back from that and stuck to the 50 basis points. This question about whether the Bank of England is as committed as the Fed is to fighting Britain's inflation. And then you've got the European Central Bank falling further and further behind on the inflation fighting program. And at the same time that the Bank of Japan was intervening today to shore up the yen, they were also signaling that they have no intention of normalizing their underlying monetary policy anytime soon, which just even further widens the divergence between Japan and the U.S. So I think that it's combining this realization that Chairman Powell is serious with raising new questions about how serious some other monetary authorities around the world are.
And that divergence in monetary policy leading to more market volatility. And of course, this is a technical economic point, but when you have sharp movements in exchange rates, it's not just a matter of trading. It's also a matter of signals it sends to investors and to businesses, because exchange rates have a real impact on investment decisions. And when you don't have stability, it does tend to deter investment by making companies, CEOs wonder, okay, well, what will be my actual return on investment given the fluctuation in exchange rates? Kim, all of this is really raising the question of, are the odds of a recession increasing? I noticed in the Fed's, the projections for economic growth that it sends out every quarter, once a quarter, and now the median projection of its bank presidents and board of governor members is now for GDP in 2022 only 0.2%. That's essentially nothing for the year. That's down from 1.7% they expected in June, which is down from 2.8% they expected in March, and down from 4% that they anticipated last December. So in 9 months, you've basically gone from anticipating growth in GDP of 4% this year to essentially nothing. And they expect another slow growth year next year, 1.2%. I even think that's somewhat optimistic. Is that what the markets are telling us?
Absolutely. And Jay Powell somewhat addressed this himself in his comments, noting that the economy was going to essentially slow to a crawl. That was their guess, and that unemployment was likely to rise to a degree historical with rates found in a recession. And market was obviously reacting in part to that. This is obviously what happens when you raise rates. Suddenly credit becomes harder to find. It's harder for companies to invest. It's harder for them to hire. Consumption goes down. And we've actually seen, I think, the beginnings of some of that in some of the announcements from bigger companies in recent weeks about coming layoffs that they're going to engage in. We already know that a number of companies have been engaged in hiring freezes. So businesses are gearing up for this tougher world. And I would just highlight that this all points to the cost of delay. The Fed did not move when it should have moved. And now it's in this position where, as you note, it's having to really ratchet up the interest rate hikes at a faster level, more aggressively. And that is what really tends to put the stopper on an economy. There's no way of knowing how much softer a landing might have been if the Fed had moved sooner, but it certainly would be better than this. And you're seeing this just because we were mentioning other countries around the world. Because so many other central banks often do take their cue from the Fed, they were slow too. And these were also countries that had pumped a lot of money into their own economies because of COVID. We were not the only ones who did that. And that has stoked a lot of demand, and coupled with some real supply problems, everyone's dealing with inflation and everyone's racing to catch up. So the whole world is in this mess together.
Joe, I'm going to give a nod of credit to Jay Powell because I think there were a lot of folks, and I think I might have been one of them, who wondered if Powell would have the fortitude to keep raising rates despite a big reduction in equity prices. And he seems to be moving on forthwith up the ladder, notwithstanding a big correction in the markets this year, in the stock markets. I guess the next question is, can he stick to that 125 basis point forecast that they're making, even if you begin to see the unemployment rate rise? So far, the unemployment rate is only 3.7%, only up from 3.5%. Fed forecast is going to the mid-4s, which would actually be a pretty good outcome if you, through this monetary tightening cycle, if that's where it stopped. But the question of financial turbulence and some financial shock from companies that are over-leveraged, going bankrupt, countries having trouble with growing and payments crises, that's a wild card of the kind you almost always see in central bank tightening cycles, and we haven't seen a big one yet.
Yeah, I mean, first off, I would absolutely agree with you that I think that Chairman Powell has impressed perhaps a lot of us, myself included, with his willingness to make it this far, even though the markets increasingly have been complaining. And I think that that was a key test that he was going to have to pass, because some of his predecessors have given everyone reason to think that they were actually a little afraid of the markets and worried about provoking a negative reaction. So kudos to Powell for prioritizing the fight against inflation. I mean, the way I would think about the kind of risk that you're talking about here is this distinction between doing it on purpose and having it happen by accident. So what the Fed and Chairman Powell think that they are doing right now is orchestrating an economic slowdown on purpose with the kind of mechanism that Kim was talking about a few moments ago, where the rising interest rates suppress business lending, which kind of increases mortgage rates and the rates that people pay on their credit cards. And so you gradually steer down demand on Main Street in that way. That's the on purpose version. But the by accident version is what we really need to worry about. And that would be this scenario, Paul, that you were mentioning, where somehow this change in financial conditions causes some sort of event in the financial markets where you really discover who are the people who have been swimming without their swimsuits on as that tide of money recedes. And that negative event in the financial system then translates into the Main Street economy. And I think that our experience with that kind of event, which is a version of what happened in 2008, is that the events on Main Street can spiral out of control pretty quickly. And I think that the Fed's concern has got to be that instead of having the slowdown that they think that they can guide in a relatively gradual, direct way, that they end up triggering some kind of problem in the financial system that gets out of control very quickly.
That's certainly what I'm paying attention to, and we hope that doesn't happen. But history suggests it will in some form as the central bank tightening continues. All right. Thanks, Kim. Thanks, Joe. Thank you all for listening. Please catch us again tomorrow for another edition of Potomac Watch.